In today's stock analysis, we are going to examine the key pillars, look at past results, see what the analysts' predictions are, create a valuation, and review then rate the company. Today we are going to look at Pfizer. Let's dive into the process I follow when reviewing whether or not to invest in a company. After I've collected all the financial information, I then analyze what I consider to be the 12 key pillars. These pillars are based on the insights and teachings of the best super investors and what I consider to be the key metrics when evaluating a company. Ideally, we would like to see each of these metrics be at least 10%. The first pillar is earnings per share growth. This is where we take the net income and divide it by the shares outstanding. For Pfizer, EPS growth over the past 12 months is 101%, scoring 1 point. Next, let's look at free cash flow growth, which measures the money a business can generate from its operations. Warren Buffett emphasizes the importance of strong financial health and prefers companies that can generate substantial free cash flow. Pfizer's FCF growth is 72%, scoring 1 point. Next, we come to revenue growth, which tells us how good the company is at generating income before deducting expenses. Their revenue growth is 2%, scoring 0 points. Now let's turn to book value growth, calculated by subtracting total liabilities from total assets to indicate equity growth for the company. Phil Town believes book value growth is the most important metric, as it has the interest of the shareholders at heart. For the last 12 months, Pfizer's book value growth is 4%, scoring 0 points. We then assess the management of the business by looking at return on invested capital and return on equity. These measures allow us to evaluate a company's efficiency at allocating capital. For Pfizer, ROIC is 3% and ROE is 5%, scoring 0 points for each. Now we move on to debt. Joel Greenblatt prefers companies that are able to pay off debt with their free cash flow, ideally within 3 years. It would take Pfizer 8.27 years to pay off the debt, scoring 0 points. With the information we have gathered, it tells us that aspects of the key pillars are strong, but others could raise red flags. So, let's find out more. Help support the channel by tapping the like icon if you have found the information helpful, and click on the notification bell to get alerts about my next videos. Now we will focus on other key pillars which help define an excellent business. Let's look at the gross margin, which indicates how much money a company retains after incurring the direct costs of producing its goods or services. This is currently at 70%, scoring 1 point. Next, we come to the operating profit margin, which tells us how much profit a company makes on a dollar of sales after production costs but before interest or tax. Peter Lynch prefers companies with strong operating margins when assessing their financial health and competitive advantage. Pfizer's operating profit margin is 19%, scoring 1 point. Free cash flow yield provides a more realistic view of a business's financial health. Terry Smith prefers companies with a free cash flow yield of 5% or higher. Pfizer's free cash flow yield is 5.43%, meeting the target and scoring 1 point. Next, we assess the 10-year book value growth as potential shareholders. For Pfizer, this is 5%, scoring 0 points. Lastly, Bill Miller believes earnings growth is the biggest indicator of a company's stock price. The 5-year net income growth, which evaluates the company's profitability over time, is 29%, scoring 1 point. In the comments section, I've included a link to the Investors Page and the annual report if you want to check it out for yourself. Pfizer has demonstrated growth in specific areas but shows challenges in others. Over the past few years, Pfizer has continued to strengthen its position in the pharmaceutical industry with new drug launches and partnerships, hitting $60 during the pandemic. However, since then their share price has now gone below pre-pandemic prices. Looking at the overview, we can see the current market cap is $150.86 billion, and revenue for the trailing 12 months is $59.38 billion. At present, their earnings per share tells us that for each share of stock, the company is generating 74 cents. Their PE ratio is about 36, which is higher than the S&P 500 average of about 28. The overall consensus among analysts is a buy, with a projected price target of $32. Analysts are forecasting Pfizer's growth to decrease by -7%, but to possibly grow up to 5% starting in 2025. This scores a cross. Let's calculate a valuation. I will use Pfizer's current earnings per share of 75 cents. Combining historical growth rates and future analyst predictions, I estimate an EPS growth of 5%. Assigning a forward PE ratio of 36, projecting 10 years forward, and applying a desired return rate of 5%, this results in a future stock price of about $44. Using the sticker price methodology, the current intrinsic value is about $27, with a buy price which includes 25% margin of safety of $20. Since the current price is below the buy price, this scores a check. It all depends on your personal view and outlook for the company, as well as the return on the investment you would like to see. When reviewing the key pillars, Pfizer scored 6 out of 12, indicating areas of improvement, and therefore scoring a cross. Past performance shows the stock on a downward trend, scoring a cross. Analysts are predicting growth to reduce by possibly 7% or grow as high as 5%, scoring a cross. The current price is above the buy price, scoring a cross. According to Morningstar, Pfizer have a wide moat, scoring a check. My final overall rating is 1 out of 5 stars. I've placed this stock in category D on my stock watch list. Thank you for joining me in today's analysis. Don't forget to like and subscribe for more insights.